Is the US economy heading for a recession, or will the boom time continue? That's the question I'll address in this video, looking at macroeconomic data like the unemployment rate, layoffs, GDP, etc., to determine which direction the US economy is heading. There's a lot to cover in this short video, so let's get right into the details. Hey everyone, I want to take a moment to thank the sponsor of this video. Moomoo is a trading platform where you can buy and sell stocks and other investments. I use the platform for investing myself. If you join using the link in my description, you can get up to 15 free stocks. So one of the more important indicators I look at when I'm evaluating an economy is the unemployment rate. When people are working, that's usually a good sign for the economy because that means that businesses see strong demand, because businesses won't hire people unless they see a reason to need people to serve their customers. So long as the unemployment rate is low or trending lower, that usually means the economy is in good shape. And as of this recording, the unemployment rate in the US is at 4.1%, near the lowest it's been going back all the way to 1950s. So you can see the job market in the United States is strong, and employers are hesitant to let people go because they'll know how difficult it is to get people back if or when their business starts to increase again. So even if there's some softness in their business, employers are keeping people and not letting them go because they see it as a temporary blip in demand and not any kind of structural decrease in consumer spending. The business confidence is an indicator shown through the US unemployment rate. One of the bigger problems in the US economy in recent years had been inflation. The consumer price index soared year over year to a level over 8% in early 2022. When inflation is rising, that creates increasing interest rates because lenders require higher rates of return for lending money during inflationary periods because they're losing purchasing power. So they want to be compensated for that loss in purchasing power. And so interest rates increase. And when interest rates increase, people buy fewer things that are connected to interest rates. When you buy a car, you usually finance that vehicle purchase, and the interest rate is higher, so the monthly payment is higher. So when interest rates are higher, people are less interested in buying cars. The same is true for homes. Anything connected to interest rates starts to slow down. And so there was a brief scare in the US in 2023 that we were going to head into a recession as a result of those quickly rising interest rates. But thankfully, that didn't happen. And the Federal Reserve took quick action, raising interest rates to try and crimp economic activity, which has worked. And you can see inflation rate is back down to normal levels, 2.6%. Is back down towards historical standards and is within range with the Federal Reserve's goal of keeping inflation around 2%. And this will continue to move lower in most likely scenarios because the cause for the increase in inflation was primarily due to supply chain constraints as a result of COVID. Fewer people were working, fewer people were getting sick more often, so they weren't working as many days or as many hours. And then you had the lockdowns and government rules that stopped economic activity. And so at the same time, I found this to be curious. Governments thought it would be smart to send out trillions of dollars of stimulus for people to go out and spend money, when at the same time they're restricting businesses and their ability to create things for people to buy. Of course, you're going to have inflation, right? You're giving people more money to spend, and then you're decreasing the amount of things they can spend that money on. And so, of course, that's more money chasing fewer goods, and that leads to inflation 100% of the time. And that's what you had there. And so now that the economy is normalizing, people are getting back to work, businesses are back to producing at full tilt, and the stimulus actions of 2020 and 2021 and 2022 are fading away. The economy is normalizing and inflation is coming back down. I suspect inflation will continue trending lower in future quarters. Another important indicator is the US initial claims for unemployment insurance. So in the US, when you get laid off, you're entitled to file for unemployment. And so this number follows that, how many people are filing for unemployment insurance. And so it keeps track of the layoffs and people getting laid off and fired and let go. And when this number is elevated, it's a sign of trouble ahead. But we don't see that here. I have 3 years of data of the unemployment claims for unemployment insurance, and it's been fluctuating. It's pretty normal at 224,000 in the latest report. Remember in 2023 when you had that increasing interest rates, and that created a slowdown in economic activity, and you can see that big increase in claims for unemployment insurance here in mid 2022 up until mid 2023. And understandably, people were concerned about a recession back then, right? The concerns for a recession were much higher back then than they are now. We mostly went through that period, and there was a lot of layoffs, right? Companies like Microsoft, Amazon, Meta Platforms, Alphabet, they laid off tens of thousands of people, and more companies did a lot more layoffs as well. But even after all of those layoffs, those people that got laid off found other jobs relatively quickly, and the economy went back to humming along, and that's where we are now. Rather normalized unemployment insurance claims. All right, then we look at US real GDP. So this measures the total economic output of the US economy. And what you like to see is the US economy growing between 2 and 3%. If it's growing faster than 3%, then you have concerns that it's going to cause inflationary pressure. If it's growing less than 2%, then you have concerns that people's real spending power is decreasing and economic activity is actually going backwards. So 2 to 3% is the sweet spot here for US real GDP. And that's where we're at right now. 2.8% was the most recent reading of US real GDP. And this number looks even better when you have inflation around the same level. So if you add to it 2.8% of real GDP and you add the nominal GDP of 2.6%, you have nominal GDP growth of 5.4% in the US. That's really strong economic output growth, and that's good. That's no indication of any recessionary pressure or recessionary concern from this reading. All right, and then the last thing I'll talk about in well, not the last thing, but these economic indicators is wealth. People are feeling wealthy in the U.S., and it's partly because of the everything bubble. Almost everything is going up in price, including the home price index, which I have in orange here. See, the home price index has roughly doubled from 2015 until today. Home prices in the US are exploding higher, and many people, over 60% of households in the US, are owner owned households. And so people are seeing their home price increase. They're feeling wealthier. And when they're feeling wealthier, they're likely to spend more money. And so that's creating a boost in the economy. And the same thing with the stock market, right? The stock market is on an excellent rally here after taking a dip in 2022. 2024 has been a great year. The S&P 500 index is up almost 30% year to date. And if you look back 10 years, the S&P 500 index has grown very nicely up to $607 in these ETF terms. And so people are feeling wealthy. Their wealth has increased. They have jobs, and they're looking around. Their friends, family, co-workers have jobs, and they're getting raises, and that's raising consumer confidence. And when consumer confidence is higher, they're more likely to go out and finance a new car purchase, buy a new home, start a new business. All of that facilitates growth in the economy. And this will be the final thing I talk about, is productivity growth. So many businesses have been able to do more with less and up their revenue without passing on higher costs to customer, a process that's called productivity growth, which has been a key ingredient for a low inflation economic boom, which is what we've been seeing this year in the US. Now, I assign two reasons for this. Number one, artificial intelligence is increasing productivity growth. Many businesses are able to do more with fewer people with the help of artificial intelligence. And I also attribute this to the rise of remote working that started in 2020. People are more productive when they can work from home. For instance, if you live in a city like I do, Los Angeles, where it takes you an hour during rush hour to commute to work in the morning and another hour to come home. So you're wasting 2 hours of your day commuting instead of being productive. And with the increase of remote working, people are able to be more productive because they have more hours available to work and they don't need to commute those many hours. Also, during 2020 and 2021, people added home offices because they were working from home. So that created a increasing productivity level when they are working from home, even if they're still commuting to work in regular hours. Maybe they put in a few hours on Saturday or maybe a few hours on Sunday to catch up on some work, and they're more productive overall because they have that home office. So overall, to answer the question I posed in the video, the US economy does not look like it's heading into a recession. In fact, it looks far from that. It looks like the boom is continuing, although slowing down. Hiring rate are slowing down, and businesses are reaching their capacity limits, and they're hesitant to add new facilities, new projects. Instead, they're raising prices to try and manage the increase in customer demand. So instead of adding that second restaurant location, they're just increasing prices because they notice that, hey, on Friday night, we have 60 people waiting for a couple of hours. We can raise prices, and even if a few customers leave, we'll still have a full restaurant rather than trying to open a second restaurant location to serve those more customers. So, yeah, recession fears are decreased in terms of the percentage likelihood of a recession right now in this December update. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.